Hello, everybody. I hope you have enjoyed the first couple of presentations. I surely have. Clara has already, can you say, started on some of the work looking at how RavenPack data can be used to explain asset prices. I will actually take a step back as part of my presentation and actually start off giving you a short introduction to news analytics. I think that will be useful for you when you listen to some of the remaining presentations, that you actually have had a look at what the data might actually look like. And as part of, can you say, that introduction, I'm going to cover some of the key attributes of what we believe makes up a news analytics data set. I'm going to go a little bit deeper in two of those attributes, which are called relevance and sentiment, and show the importance of those two, let's call them dimensions, referencing some academic research that have been done on these indicators or these analytics. I'm then going to move on into looking at the sentiment data from a sentiment trend point of view, so moving from the story level, event level analytics and up to an indicator that captures the sentiment trend, for instance, on a given company. And I'm using those indicators. I'm moving into a case study where we try to build some very simple short-term, long-short portfolios on different regions. So looking at how these indicators would have performed in Europe, in the US, and in emerging markets. Using these same indicators, then that's kind of my part of the presentation. I will then at that point hand over to Akash, who will be talking on how news analytics can impact the supply chain. And he will be working on present based on some of these aggregated indicators and apply those, can you say, looking at news on related companies rather than on the companies themselves. But first of all, I think we can all agree that news move asset prices. And some of you, if not all of you, already to some extent trade on news, either using earnings or analyst recommendations or other things. But it's not all about, can you say, those more traditional sources of information, news information. It's really about, can you say, also, as Clara mentioned, picking up on unscheduled news that will also move stock prices. And there hasn't really been very good opportunities to do that systematically previously. It's only in the last few years where news analytics providers have started to pop up that this has become possible. And of course, when you look at these unscheduled news where there's, more or less 100% unanticipated. Okay, I'm discounting potential insider trading here, but at least you can expect that to be of great importance. What you have also seen is that more and more focus has turned to web sources. So the first products that came out within the news analytics space were kind of tied to some of the what we call the premium news wire services, such as Dow Jones or Reuters, and you can say more recently also Bloomberg has moved in here. But web, as we see it, starts to play more and more of a role, an important role, when you want to capture all the information that is out there. And obviously, having to move to the web to get, can you say, all the novel information available, it starts to become a very challenging exercise because we're talking about thousands of sources here. And it's something that is almost impossible to figure out in a manual way, It's almost impossible to interpret in its raw form. So what you really need to be using is some automated and systematic process for information extraction. And that's really where RavenPack can help you. So let's look at what some of the information or some of the analytics that you could receive from RavenPack looks like. This is only a selected, hand-selected set of indicators we have, or analytics. We have more, but these have been selected just to highlight the key attributes that I was talking about before. So we deliver information in real time, and that is reflected in our timestamps here that are delivered down to the millisecond. Right? But the first of the 5 key attributes is entity recognition. obviously you need to understand what entities are the news about. Otherwise, you can't really make any trading decisions. You need to know whether you have to trade or whether this is related to Google or Apple, or whether it's about the US economy, etc. So good entity recognition is obviously important. The second and important attribute is relevance. So one way of detecting, or figuring out doing entity recognition, just looking at who's mentioned, what companies are mentioned in the text. Relevance will help you filter out noise, because companies or places can be mentioned that it's not really about them. So for instance, if you look at Goldman Sachs changing its analyst rating on IBM, well, it's about IBM. You don't want to make decisions on Goldman Sachs based on that information. And here, relevance is a very good way of filtering out that noise. In this particular case, I have filtered for relevance of 100. It moves generally from a scale from 0 to 100. 100 has been selected because that means that we have detected the entity playing a target role in an event. But there's also information moving below relevance 100. The third attribute is the actual event detection. And we have a pretty elaborate event taxonomy, and we cover well above 1,000 different types of events on the macro side, as well as on individual company type events for individual companies. And these are just a selection. And we're even able to, detect the different roles that companies may play in an event. So who's the plaintiff and who's the defendant in a lawsuit, or who's the acquirer or the acquiree in an acquisition. So this is very useful information for many different reasons. Clara mentioned one, and that is for filtering purposes, to understand or to figure out what news actually drives prices, and also just as importantly, what information is just noise, or looking at the past, such as order imbalances or stock price moves. So it definitely allows you having this information available to filter more heavily or more aggressively on the data, and that is really a key when working with news analytics data set, to have opportunities to filter, get rid of noise, and that is one of the big challenges. The other thing that you also get with events as compared to sentiment, which is the next one I'm going to mention, but what you get with events as well is information about potential decay. So how long does a given signal actually last? So it could be, for instance, that a positive analyst recommendation only lasted for 2 days, but a negative analyst recommendation lasted for 5 days. And that's something you don't get off just having a sentiment score available, because sentiment, which is the fourth attribute, is more about direction and strength, not about how quickly something decays, right? So the combination of event detection and sentiment becomes important. And finally, and the final and fifth key attribute is novelty. So how new or novel is my news? Have I seen a similar type of event involving the same entities within some time frame, whether it's 24 hours or a week? It doesn't really matter much, but the notion of novelty is also important. And that could, again, be used either for weighting purposes, if you aggregate information up to a sentiment indicator, that you say, I want, the first time it hits, it's more important than the fifth time it hits. And, or you could also just be using it as a filter. And especially when you want to start moving in on the web, novelty becomes extremely important. So this is an academic study. I just wanted to show the importance of relevance of sentiment. This is an academic study done by INSEAD, where they took the RavenPack relevance score and categorized news as being either highly relevant to a company or having low relevance. And then they multiplied the sentiment direction onto the returns of the stock following the event. They focus on intraday in this case, so the 120 which you see on the x-axis is in seconds, so it's 2 minutes after the event. And what they find is that there was basically no price reaction on average for low relevance records. But they saw a significant reaction to stories or news records where RavenPack has said it had a high relevance. And over these 2 minutes, they found about a bit more than two 2 basis points. So this is basically just showing that there is value in can you say, being able to filter for relevance and adding sentiment on top of it. But it's not just about, can you say, these individual records and about event trading. This type of information can also be aggregated up and over time or across entities. So you can create, can you say, company sentiment indicators to capture the trend on a given company, or you could do it on basically on any proprietary basket of stocks you're interested in. That could be at a sector level or even at a market level. And when we move on to the supply chain results, we actually more look at news from a proprietary basket, but across, let's say, looking at the supply chain or something like that. But so we have done quite a bit of research internally on how you might go about creating these sentiment trend indicators for companies. And this is, can you say, our internal methodology that we, can you say, continue working on. But this is kind of where we are at the moment. So we basically jump off from ESS, our event sentiment score that I showed you before. And it's a very, very nice way of having a normalized view across different types of events. So just aggregating across that and basically ignoring the actual events. We have done a bit of filtering, applying similar filters as Clara did with stock prices and order imbalances. So you basically, you definitely still want to some extent take events into consideration. We typically apply a 3-month aggregation window or exactly 91 days for 2 reasons. Or 3 reasons actually. First of all, we capture by selecting a equal number or 13 weeks, full weeks of data. We capture or span the seasonal sentiment pattern that you see on a weekly basis. You typically see more negative news being reported towards the end of the week before the weekend. It's kind of a known issue than you do on Mondays. We also span an entire earnings cycle, so a 3-month earnings cycle. So that's also for capturing that. The second or the third reason for doing it, using a relatively long window is that we actually have opinions about more stocks. Not all companies are equally liquid in the news, and therefore we kind of say, okay, let's look back 3 months to kind of increase the set of companies that we can use in our ranking. But of course, by increasing the aggregation window, you can potentially make decisions based on relatively old news, and that's obviously not that interesting. So to kind of address that, we apply an exponential sentiment decay function. So allowing more recent news to matter more than older news. And on top of that, we actually add a second decay function, which is very similar, but we then add a normalization to it as well to ensure that the score goes between -1 and 1. But that second decay we call a time weight function, and it's basically dependent on the news flow patterns. And in effect, what you get out of it is that the sentiment decays faster when companies have a lot of news than when companies have little news. And it's somewhat driven by some empirical facts that we have seen, that news just gets incorporated faster into stock prices when you look at large caps than when you look at small caps. And large caps typically have more news about them. So to kind of get that effect in there and being able better to rank across different market caps, we kind of have built that into the indicator itself. And also what it does is that it tends to zoom in if you see bursts of information. So if you have had 10 days with 1 positive news item on each, and you then suddenly see one day today with 10, you kind of zoom in and say it's really the 10 negative ones that occur today that should drive it. And because we are, there's a lot of quants here, I just included the formula as well. And as you can see here, you have the 2 weighting functions, and here's the normalization I'm talking about. All right. So we took this indicator and just said, how did this indicator perform across in Europe, in the US, and in emerging markets? And in order to do that, can you say, quick study, we ranked our universe according to our sentiment strength indicator. and we cut that indicator 30 minutes before market close and assumed that we could trade on the close. We would go long the top 20% of companies with the most positive sentiment and short the 20% of companies with the most extreme negative sentiment. So very simple strategy. We would keep it for 2 days and apply 10 basis point transaction cost, and we would just equal weight the portfolios. Right. We could, you could move beyond the 2 days. I would say the 2 days was selected. You do get stronger results on the shorter horizons. Obviously, you also get higher turnover. But even after transaction costs, it's 2 days seems to be a pretty good trading horizon. Especially, I would say in the US, if you do take this very simple approach, you're probably looking within a week. But the signals can be extended beyond the week if you take a more sophisticated approach. But even with relatively simple approaches for Europe and emerging markets, we have found value, can you say, 10, 20 days out. So these are the results that we found for Russell Europe universe, which was our benchmark or our universe here. So going back to 2007 and covering through 2013, overall we got an information ratio of about 2.5. So it has done pretty well in Europe throughout. As you can see, 2012 seems to have been the most challenging year, but still we were able to get an information ratio above 1. If we move to the US and focusing on the Russell 3000, you can see it's been a little bit more challenging recently. 2012 again seems to have been a quite challenging year, but it has come back up a bit in 13. I will say this result has primarily been driven by a more challenging, can you say, more challenges in the large cap universe. Mid and small cap seem still to have performed pretty well through this period. Overall, we get an information ratio about 1. Moving to emerging markets, again, it has done pretty well, information ratio of about 1.4. Here, it seems to be that the challenges are more through the financial crisis here, or 8 and 9. And I will show you a picture that highlights that a little bit more, and you will actually see something similar for the 2 other regions as well, but still somewhat of a difference. And then just for the fun of it, we did a very simple global portfolio. So we just looked, let's say we take those 3 regions and equally weight them to see what we will get. And it seems as if there are some good diversification effects to be had. And we end up with something like 3.4 for the global strategy. We found about a 40% correlation between the US and the European strategies, and less than 10% when looking at emerging markets against the other 2. So overall, Europe seems to have shown the strongest results, and there seems to be some diversification effects by trading a global portfolio. I will say though that probably here for Russell, the 10 basis points may be a little bit too aggressive. So this is what it actually looks like from a cumulative return point of view. So the red line is your European universe, the green line is your emerging markets, and the blue line is your US universe. And I think there's something quite interesting going on here through the financial crisis. And you see that there are differences when it comes to more developed markets versus the emerging ones. Both Europe and the US seems to have followed a similar pattern that being long positive sentiment stocks and short negative sentiment stocks seems to have been the right thing to do up until the bottom of the market, after which there seems to be more of a reversal, or the revert relationship, but that only lasted for a few months. And we have seen that in other types of studies as well, that there seems to be some sort of regime shift or break here that lasted for a few months. And whether that is that people through this period were more short-term and perhaps overreacting to the news intraday, and then you actually see more of a reversal effect in the coming days, I don't know. But at least we can observe that there was something here. But if you look at emerging markets, you also saw some sort of a breakdown, but it was much earlier. It was it was already back in 2008, and that was why you kind of saw that that 8 and 9 were challenging for emerging markets. But interestingly, they all seem to go back to the usual normal interpretation around the same time, right? So about mid 2009, that you again should be long positive sentiment stocks and short negative sentiment stocks. So that's can you say some of the things that we have found with this simple aggregated measure. There's obviously other and more sophisticated ways of using it. At this point, I will like to hand over to Akash Ramchandani from FactSet, who will take you through some of the work that has been done on the supply chain relationships.